Hello everyone, and welcome back to Explain the Charts. Today is October 18th, 2025, and we're taking a deep dive into Ethereum, which is currently at a fascinating crossroads. We're seeing a powerful clash of narratives. On one hand, there's immense institutional interest and whale accumulation, but on the other, short-term price action and market sentiment are flashing warning signs. First, let's break down the news that's shaping the market's perception. Yahoo Finance recently highlighted a significant 20% rebound for ETH after it crashed to lows near $3,430. A key driver for this bounce appears to be whale wallets, which have reportedly scooped up around 80,000 ETH, worth over $330 million since October 11th. This suggests that large, long-term investors are confident at these prices. Conversely, other reports from the Crypto Times and CoinMarketCap point to a recent market-wide sell-off that dragged ETH down 9% over the past week. This was fueled by over $1 billion in leveraged liquidations, pushing the crypto fear and greed index down to a score of 28, indicating extreme fear. This fear is amplified by broader economic concerns, such as soaring auto loan delinquencies and warnings of an AI-driven bubble on Wall Street. However, the institutional bullish case is incredibly strong. We're seeing firms like BitMine making strategic buy-the-dip moves, acquiring hundreds of millions of dollars worth of ETH. BitMine now holds over 2.8 million ETH and has stated its goal is to acquire 5% of the total supply. Furthermore, Nasdaq-listed SharpLink Gaming just raised over $76 million specifically for additional ETH purchases, signaling robust corporate confidence. We also have major players like Grayscale committing $150 million to ETH staking and VanEck filing for new ETH-related ETF products. Analysts are even discussing bullish price targets of $6,000 to $6,900 for 2025, contingent on sustained ETF inflows. So we have a clear battle: fearful retail and short-term traders versus confident, accumulating institutions and whales. Adding to the long-term bullish case are major upcoming network upgrades, such as the Fusaka upgrade in December, which aims to double Layer 2 throughput, and danksharding in 2026, which is expected to slash Layer 2 fees by up to 90%. Now, let's see how this dramatic push and pull is reflected in the charts. Looking at the daily chart, the bigger picture shows a significant downtrend from the August highs near $4,800. We saw a dramatic capitulation candle on October 10th, where the price plunged from around $4,370 to a low near $3,500. This sharp drop aligns perfectly with the news of widespread liquidations and market fear. However, what's crucial is that buyers stepped in aggressively, forming a strong support base right around that $3,430 to $3,500 zone, which was mentioned in the reports as the crash low. Following that crash, we saw a powerful V-shaped recovery, with the price rocketing back above $4,100 by October 12th. This bounce directly correlates with the reports of whale accumulation that started on October 11th. Since that peak, the price has been pulling back in what appears to be a period of consolidation. Right now, ETH is trading around the $3,830 level. This current price action fits the narrative of a temporary pullback before a potential next leg up, as suggested by some analysts. From a technical standpoint, we can identify our key levels. Immediate resistance lies at the psychological $4,000 mark, followed by the recent rally high around $4,130 and the crucial zone between $4,300 and $4,390. To the downside, our immediate support is the recent low at approximately $3,670. Below that, the most critical support zone remains between $3,550 and the major low of $3,430. A break below this level would be a significant bearish signal. Let's zoom in on the daily chart, focusing on the action since that October 10th crash. You can clearly see the massive selling pressure on the 10th, followed by an equally impressive buying response over the next 2 days, forming long lower wicks and strong green candles. This confirms that significant buying interest exists below the $4,000 level. The pullback over the last 4 days, from October 14th to the 17th, has occurred on noticeably lower volume than the preceding up move. In technical analysis, a pullback on diminishing volume can be a bullish sign, suggesting that the selling pressure lacks conviction. This could be the handle forming for the bullish cup and handle pattern analysts are watching. The price is currently coiling, which typically precedes a significant move in one direction. Now, switching over to the 1-hour chart, we can get a much clearer view of the recent price action and short-term trends. Here you can see the steep downtrend from the October 13th high around $4,295. The price has been making a series of lower highs and lower lows. However, over the last 48 hours, that downtrend has stalled, and we've entered a sideways consolidation range. The price has been oscillating roughly between $3,820 on the low end and about $3,960 on the high end. This tightening range indicates a buildup of energy for the next move. The structure we're seeing could indeed be the formation of a rounded bottom, which would serve as the base for the handle part of the larger cup pattern. We need to see the price start making higher lows and break above the top of this range to confirm short-term bullish momentum. Drilling down to the 15-minute chart gives us an even closer look at the current battle. We are in a very tight range at this moment. For day traders, the key levels are clear. A sustained break above the immediate resistance around $3,850 could signal a push towards the top of the hourly range near $3,960. Conversely, if sellers take control and push the price below the recent support at $3,820, we could see a quick drop to test lower levels. The price action is choppy here, reflecting the market's overall indecision. It's a classic standoff between buyers trying to form a bottom and sellers trying to continue the short-term downtrend. So, to recap everything on the daily chart, let's summarize the key price levels and potential scenarios. Keep your eyes on these critical zones. Major resistance is at $4,000, the $4,130 to $4,390 range, which would complete the cup. And then the previous highs around $4,500 and $4,750. On the downside, key support is at the recent low of $3,670, followed by the major psychological and technical level of $3,500, and finally, the crash low at $3,430. Now for our unbiased predictions. The bullish scenario, which I believe has about a 60% likelihood, is that this pullback holds above the $3,670 support. The overwhelming institutional buying pressure and on-chain whale data suggests this is a consolidation phase before the next leg up. If we see a bounce from here and a decisive break above $4,390, the technical target would be in the $4,550 to $4,750 range. This scenario is reinforced if we see continued large ETF inflows and a stable broader market. The bearish scenario, with a 40% likelihood, would be triggered by a failure to hold support. If macroeconomic fears intensify or we see large ETF outflows, a break below $3,670 with conviction could lead to a retest of the $3,500 support zone. A break of that level would invalidate the bullish cup formation and could open the door to a much deeper correction, possibly revisiting the $3,430 lows. The main things to watch for are a breakout from the current hourly consolidation, ETF flow data, and any major macroeconomic news. Also, keep the upcoming Fusaka upgrade in December in mind as a potential long-term catalyst. Finally, it's crucial to remember that this video is for informational and educational purposes only and is not financial advice. The cryptocurrency market is highly volatile, and you should always do your own research and consult with a professional before making any investment decisions. Thank you for joining me today at Explain the Charts. If you found this analysis helpful, please hit the like button, subscribe to the channel, and we'll see you in the next one.